here's the big question. You're interested in value investing and valuing and evaluating businesses on a deep level, but you don't know how, even after researching for hours, probably dozens of hours, hundreds of hours on the internet, and because nobody else shows you how to do it. This podcast has all those answers and much more about value investing in finance. My name is Jason Rivera. Welcome to Value Investing in Your Car. Hey, Jason here. Today I want to talk to you about a conversation I had last week with a client about capital allocation. It was a phone conversation. I wish I would have had my phone recorder on so I could have recorded it, but I did not. So I'll just have to recap here for you the highlights of what we talked about, how it affects you, why it's so important, those kind of things. Main thing this client wanted to talk about was, because we've talked several times about capital allocation before, so this conversation was more about some specific situations and how I think about them based on my years of experience reading and learning about and implementing these techniques. So this guy runs multiple businesses in the millions, tens of $millions plus range. He is at the point now in one of his businesses where their operations and everything are doing well, but they want to tweak things and improve things to continue to improve the company. But that's not all. They want to continue improving their cash flow. They want to know how to use their cash flow. They want to know how much cash flow they actually have access to via the various sources, all that kind of stuff. So I've talked a lot about capital allocation and what that is. So if you want to watch one of those videos, it should be linked below to the side wherever you're watching this. Go watch one of those videos where I explain more in depth what capital allocation is. Also got videos where I talk about its importance, so we'll watch those as well. Again, my team will hopefully link those videos below for you, and so you can watch those videos. So I don't want to talk about that today. However, some specific situations when it comes to capital allocation I do want to talk about that we talked about during our conversation. So, and this was just an example. So he said, let's say I have $1 million in excess cash flow. How would you look to invest that? I said I would look to invest it, A, paying down debt. They don't have any debt, so that's not an option. I would look to see where to invest that capital, where I would get the highest return on that capital. Whether that's investing in furthering efficiencies, building systems, doing more training, hiring more people, doing more sales and marketing, essentially increasing internal operations. That's one option. Another option is becoming more efficient as a company, cutting costs, unnecessary costs. Raising prices falls into that, if they can raise prices. Using their resources they already have better for not only better usage, but also more usage to get more usage out of their current resources they have available. And I'm not going to get into specifics about this business because I have an ongoing relationship with this person, and frankly, I just don't want to get into that. It's not important for this conversation we're having. So we talked about that. Then he asked a great question. What do you define as excess cash flow? Oh, and let me go back. So that is options 1 and 2. Option 3 would be expanding externally and the kind of stuff we've talked about a little bit before in the other videos. So he next asked a great question. What do I determine as excess cash flow? Do I have a hard and fast rule of what I determine as excess cash flow? The answer to that is no. What I do to determine excess cash flow is it depends hugely on the business model of the company. If it's a company that requires a lot of purchasing of equipment, expensive equipment, heavy machinery, contractors equipment, um, just overall heavy machinery that costs a lot to replace or repair. If it's that kind of business, then you have less excess cash flow available, typically lower profit margins, typically less free cash flow, which all goes into consideration when I'm talking with a client. This company is on the other hand. They are in the information business, for lack of a better term, because again, I'm not getting into details on this company. They're in the information business. So what they do, they have high profit margins. And because I know I've been around this business before, I've dealt with these guys before, and I've actually been in this industry before, I guessed that their profit margin, their operating profit margin was probably in the 40% range. So he looked at his numbers and it was, I think he said almost exactly 40%. So that's great. Most businesses don't have profits. If they do, I deem good to great companies having operating profit margins over 10% on a consistent basis. So you're 4x that, which is fantastic. So we talked about some of the options on excess cash flow, and we went even further into that. So for his business, what I said is, and again, I haven't looked at the financials. I said if you need me to look at the financials, I will, and we can set that up, and it'll be confidential, all that. But as a rule of thumb, this is what I recommend to people. You make sure, let's say you have $1 million in operating profits. Again, we're just going to use operating profits here as a proxy, as interchangeable with free cash flow as well. Because in this business, they should be relatively close. Or in this business model, they should be relatively close. So let's say they have $1 million in operating profit. I would put, again, this would be based more on the financials, but a rule of thumb that would give you a margin of safety and conservatism. 50% of that into the bank in case something happens, in case you, pretty much in case something happens, in case a recession happens, whatever. So you have capital there that you can use as you need it without having to go take out unnecessary debt. I'll put that in the bank. They don't have debt, we already talked about, so you couldn't pay off debt. I would then look to take, so 500,000 is left out of the million. Out of that, I would put half of that, so $250,000 or the remaining amount, into investing in your highest, best, safest return, and we would help you figure that out. If you haven't watched the previous videos, that would be, again, things like internal operations, external expansion, acquisitions, buying other private businesses, doing private joint ventures or partnerships, looking at investment real estate, whatever the case may be. Any of those assets, we'd look at that. The other assets, so $250,000, we would look to use as, we would keep on hand essentially, so we could use it as we see fit. As we work our original strategy, we can either put more money there into that original strategy if it's working. If it's not working, we then go to another place. So we give that some time, and we would 6 months, a year, whatever, and we would look to invest that capital over and over and over again to bring in more capital so that they can then invest. He then asked another great question about line of credit. They also have a line of credit. He said, let's say, for example, we have a $2 million line of credit that, frankly, I forgot about until now because we never use it. Okay, fair enough. So that changes the equation a little bit, because now you have $3 million total in this example that we were talking about to play with for investing in whatever you think your highest, best usage is. So in this case, what I would do is I would look at their financials, talk with the company more in depth, meet with people, and build a plan for them step by step on getting them towards their goals. So if they need to increase, one of their major problem areas is the finance department, CFO, that area, we would look to improve that, hire another CFO, whatever the case may be. We would look to do more marketing if that was the case, better sales, all that kind of stuff. I wouldn't just use necessarily all of the capital towards one use, because again, as a value investor, a margin of safety, even though I believe in being concentrated, and I do, but you never know what's going to happen, and you want some money left over, again, dry powder. So about half of that money would be left over as dry powder in case we needed it for whatever reason. Another thing to consider is, because I'm a value investor, is I like to do things as well as possible, as cheaply as possible. So I would look to, let's say we wanted to hire a new salesperson. That doesn't take much capital, because most of their earnings will come from commissions. Let's say we want to hire 10 salespeople. This is one thing I would consider, is looking at ways to use their resources without necessarily having to even spend this capital. How to get a better return and optimize marketing. All these things come into play, so I wouldn't necessarily even be able to use the full $3 million even if I wanted to, because again, I would be looking to do the best job possible at the cheapest rate, or at least spend their capital the best possible way and the cheapest way possible, and the most efficient way possible for them, so we could use the capital more efficiently. This is another way of capital allocation, is trying to do things better, trying to do things more efficiently, but as cheaply as possible as well. When you're hiring people, there's creative ways you can do things with, again, hiring salespeople, give them a small base salary, and then make most of their remuneration pay off of sales, or off of actual sales, hard sales, commissions. So that's a couple of things we talked about when it came to that. The line of credit, because again, I know their business model, I've worked with them in the past, and I've worked in this industry before. I know that unless you have these insane costs, you are going to make a lot of money pretty constantly, unless you just piss off your suppliers, customers, clients, whatever. You're going to continue making money. So I also told them I can guarantee, almost without looking at your financials, knowing what we talked about before, the size of your company, how much profits you produce. Again, I only have to look at the financials because I know this and the industry economics. I can almost guarantee you can go into your bank or whoever you have your line of credit with and up that to $5 or $10 million if you really wanted to. Now, why would I say that? That is essentially more debt if you use it. That's the key difference. Line of credit, between debt and line of credit, debt is something you take out now that you can use later. Line of credit is something you open. It's like a credit card. Something you open and you can use it if you need to or want to, but you don't have to use it. The reason this is important is because if they take out, let's say they up their line of credit to $5 or $10 million, and their interest rate on that is still, I think he said it's about 4.5%, 5% now. Let's just say 5% for an easy round number. If they can take that, even the full $10 million out, or use the full $10 million on the line of credit at 5%, but they can invest that money, that capital, at even 10%, they're doubling their money. I want to go back over that because that's a very important point. If they can take their line of credit out at 5 percentage points and they can invest it at only a 10 percentage point return, they will double their money like that, or within a year, or whatever the time frame is, or whatever. So essentially they could turn that $10 million into $20 million if they allocated that capital well, pretty quickly. Again, I know this industry, and it's I wouldn't say it's easy. No business is easy, but because they are known quantity and very powerful in this industry, they probably could do that if they allocated it well. So why would I recommend that? Value investor is all about conservatism. Because right now interest rates are so low, and they're actually still going lower in the United States. They just got cut by 0.25%, and they probably will cut them 2 or 3 more times, they said, by the end of the year. Because Apple is a great example that I talked about specifically in this phone call. When I think it was 2012-ish time frame, Apple had enormous billions of dollars worth of cash. They had an incredible margin of safety in everything on their balance sheet, everything, but they were still taking out debt. Why were they doing that? They were taking out debt at low interest rates. I think it was 2 or 3% if memory serves me right. And they were reinvesting and buying back stock because they thought it was undervalued. The way I explained it to this client is, if you buy back stock and the company is undervalued, you're immediately creating value. Because let's say it's 50% undervalued. You're immediately creating 50% percentage points of value because you're buying back an undervalued asset. Now, what happens if you do the reverse? If you buy back shares that are overvalued, you're doing the same thing, but in the reverse bad way. So what should you do if you have an overvalued stock? In many cases, you should issue shares, because you are issuing shares at a 50% premium to what you think the value is, so you're earning 50% more money on your, or 50% more on your capital. Again, I hope this makes sense. This is some high level stuff, and I hope this makes sense. If it doesn't, anything doesn't, let me know in the comments below. But these are some of the things we talked about in this conversation. And what are some other things we talked about? We talked about operating profit versus net income, which I've talked about at length. So I'm not going to go over that again. You can watch the videos about that or go to the post. Why PE is useless. I think there's a blog post about that, a value investing in your car episode on that. So I'm not going to get into that. What else? Specific situations. Because if you invest your capital well, what does that mean? A, what does that mean? B, how do you measure it? These are things people don't think about. So let's say you want to hire a director of marketing. How do you measure for $100,000 a year? Let's say you hire a director of marketing for $100,000 a year to improve your marketing. How do you measure that return? How do you measure the return on that? So we talked about that. What I would do is, let's say we hire a marketing director for $100,000. We give him $50,000 for ad budget for the whole year, or him and his team, whatever. Ad budget for the whole year. Another $50,000 for his entire team, so $200,000 total per year. I would want them to return at least 10% every year on that capital. So they would need to earn at least $220,000 total, at least. And again, that's where efficiencies come in. That's where using your resources can compound these things, and that's where all these kind of layers come into play. But you have to think about these things. First of all, is if I'm going to measure something, what do I need to measure it against? In these kinds of situations, I look for a minimum of a 10% return on capital, which is why I said the 10% number. Now in marketing, you can get just negative return, like in most areas, if you're not doing things well, or you can get 2, 3, 4, 5x returns. even 10x returns or more if you were doing things fantastically. So 10% is just kind of a baseline for what I look as my baseline for investing capital. So I would need them to earn at least $220,000 in that year to make sure they were earned their cost of capital in this case. So again, there's another point. What is cost of capital? If any academics are watching this, I know you're not going to like this definition. I'm telling you right now, you're not going to like this definition. In my opinion, cost of capital in a real world sense, you have to consider things like time, actual money, resources, effort. You have to consider these things when you want to think about anything, but just say purely in terms of capital or money. What is cost of capital? How do I define cost of capital? And that depends, again, on your business model, on if you have debt, on these kind of things. But let's say you're in this industry, this company is, and this company has zero debt. So I'd essentially say their cost of capital is zero right now. They have zero debt. Now, again, you have to take in consideration effort, inflation, taxes, your time, all this stuff. So leaving that aside, yes, I know that you need to consider that. Leaving that aside, just for the monetary perspective. So if they can take out debt at 5%, that would essentially, their line of credit would be 5 percentage points or about there. So their cost of capital, if they do that, would be 5%. If they can earn 10%, they would be out earning their cost of capital. And again, essentially doubling their money. Again, I know if you're an academic, that's not the correct way to look at things. Frankly, I don't care about cost of capital very much. As long as you're earning what I deem to be good returns, again, generally over 10 percentage points on ROIC, I'm good with that. Because frankly, if you're doing that, you're in the good to great business arena right now. Should you try to earn more than that? Of course you should. But I found that probably over my experience over the last 12 years plus evaluating thousands of companies from all over the world, that probably fewer than 5%, probably less than 2% of companies in the entire world earn 10% returns on capital over the long term on a consistent basis. Fewer than probably 2% of companies. That's insane. So if you can do that over time, it compounds very, very, very fast. And can turn a little bit of money into a lot of money. So those are most of the things we talked about in this conversation. A lot of the stuff I've never talked about before, stuff like cost of capital, stuff like that, because I don't frankly use or think about cost of capital very much, but he asked me a specific question about it. So if you have any questions, comments, concerns, let me know in the comments below. I'd love to hear your thoughts on this, but I wanted to recap this video, this conversation for you, because I thought there was a ton of value in it for you on things you need to think about if you're allocating capital or want to know more about allocating capital well. I think there is a ton of great stuff in this conversation, so I wanted to share the highlights of it with you. If I think of anything else, I'll put it either in the comments or make another video, because I'm sure I'm missing something. Again, I forgot after I got off the call. I thought that I was recording and I wasn't. So I apologize for that, but I still hope you found value in this. And I forgot to say this at the beginning. This was a value investing in your car episode. And in this episode of Value Investing in Your Car, we're going to talk about capital allocation and some of the specifics of this. And you can get this podcast anywhere in the world for free on all major podcasting platforms. So make sure you listen to this on all on those as well. If you're interested in podcast, Apple, iTunes, Spotify, Stitcher, SoundCloud, Anchor, and more. It's all available on all podcasts. If you're watching on YouTube, make sure to watch or like, love, share, subscribe. If you comment, again, I look at all comments and answer all comments myself. So I'd love to hear your comments, thoughts, concerns about this. If I missed anything, if you thought I got something wrong, let me know. But I hope this brought you, more than anything, I hope this brought you a ton of value. So, because I thought this was a very valuable conversation that I wanted to share with you. So, until next time, talk to you soon. Have a great day. Bye.